Investing, that word used to really scare me when I was younger. And it's because I always thought it was meant for the financial elites and was like solving a Rubik's Cube to understand. But up until a few years ago, that I actually learned just how pretentious it all was. Welcome to Finance for Everyday People, where I, Jeff Mora, teach you personal finance the way you should have been taught. Because if an everyday guy like me can learn, then so can you. So in this video, I'm going to talk about the fundamentals of investing, talking about exactly what it is, why people do it, some common vocab and terms people use, and exactly how it builds wealth for you over time. I asked AI to define investing, and it gave me this definition: the act of allocating money into assets or ventures with the expectation of generating income or appreciation over time. So, what does that mean? It means you can put up money today into something, hoping that it will generate you future income that is more than what you initially put into it. When we say assets, what that means is a resource with economic value that is owned with the expectation that it will provide future benefit. So when we say investing in assets, what that could be is investing in stocks, which is what we'll focus on in today's video, but it could also be investing in property, like buying a home and then later selling it for a higher price. Or maybe you're buying rental property where you hope to gain passive income through rental payments. Getting a college education is an investment. You pay X amount for 4 years to get a degree in hopes that that degree will then get you a career that will generate you more income than what you initially put into it. An asset can also be a business. Investing into a business, like venture capitalists, who are just those big companies that invest into startups, hoping that those startups become big profitable companies where the venture capitalists will then get their money back plus some. In this video, I'll be strictly talking about stocks, but a lot of the terms and definitions do apply to other examples of investing. Now, what is a stock? A stock is a security representing partial ownership in a corporation. So I can buy Apple stock and that will make me a partial owner of Apple. A share is a single unit of ownership in a company or financial asset. So to become an Apple partial owner, I need to buy shares. And a share for Apple might say be $50. And if I buy 2 shares of Apple, that's $100. That means that I invested $100 into Apple as my investment to buy 2 shares in hopes that those shares of Apple will generate future income for me. Now, there are hundreds of thousands of shares out there, so I'm not the only owner. There are actually hundreds of thousands of other Apple shareholders. You might ask, well, where do I buy these shares? And you buy these shares at the stock market, a collection of exchanges and marketplaces where securities such as stocks are bought and sold. So you can think of the stock market as like a grocery store and the shares of Apple as like actual apples. I go into the store and buy 2 apples at $50 a piece. That means I've invested $100 for 2 apples, and I'm hoping that I can sell them, say, a year later for more than what I paid for them. To be a bit more technical, that $100, which was our initial investment, can also be called our principal. Now, whether or not I actually sell them a year later for more or less than what I paid for them is what we call the return, the gain or loss generated on an investment over a specific period of time. So with the same example, let's say today I buy 2 apples from the grocery store at $50 a piece. A year later, I go to sell them, and it turns out the price of apples are $60 a piece. If I sold all my apples, I would make $120, meaning that $20 difference between what I paid for them and what I sold them for is my gain. $20 from the $100 I initially put in is a 20% return. Now, that all sounds dandy, but where a lot of people see risk and are scared of the stock market is because you can lose instead of gain. Let's say in our example, a year later, the price of apples actually decreases to $40 a piece. If I go to sell my 2 apples, which I initially paid $100 for $80, that means I lose $20, aka a negative 20% return. And as an investor, that's always the risk you take. But the key thing to remember is that when you're an investor, you choose what you want to put your money in. So if I see that in the last, for example, 5 years, apples have fluctuated in price. One year they're $50, the next year they're 60, the year after that they're 30, the year after that they're 100. That, as an investor, might seem pretty risky because when I do decide to sell, I'm not quite exactly sure what price they'll be at, and I risk running that loss. But let's say bananas, on the other hand, have a steady increase year after year, where one year they're 50, the year after that they're 55, year after that they're 52, year after that they're 60, year after that they're 55, year after that they're 67. So it's really up to you how you want to spend your money based on how much risk you're willing to tolerate. And that leads us to another strategy known as diversification. Because some assets might be riskier than others, it's a good idea to have several different assets in case one of them goes down. Some other ones might go up to kind of balance out your overall net return. Going back to our real case example, I might buy some shares of Apple today, and then tomorrow go and buy Google shares and Microsoft shares. Because a year from now, Apple shares can decrease in price, but Google shares and Microsoft shares could increase in price. On the other hand, if I had put all my eggs in one basket and just kept buying Apple shares, then I really have a negative return. So I think it's here where we lose a lot of people and turn them away from investing, because you can buy a stock and it is possible things take a dramatic downturn, but just because that's possible doesn't mean it's probable. Again, it all depends on how you choose to diversify your portfolio and if you choose to buy risky, volatile stocks that are known to have big jumps and big falls. But for the most part, the smart investor invests in stable, steady stocks that have slow but steady increases over time. Now, this is how you build long-term wealth through stocks with the eighth wonder of the world known as compound growth. Compound growth is like a snowball. You start with a small, tiny ball at the top of the mountain, and as it slowly goes down the mountain, you'll see that it starts getting bigger and bigger and bigger to the point where you truly can't stop it. And in a later video, I'll talk more about compounding, but for now, just know that it's better to keep your money safe in a steady growing stock than it is to buy some risky, volatile stocks where you might lose a lot of money. Less risky might be less fun, but more stability increases your chances of growing future wealth. So let's recap what we learned today. We know that investing could be putting money into an asset like stocks, but it can also be real estate or a new business idea. In the case of stocks, we talk about shares as the unit that companies sell a piece of their company for. You buy these shares at the grocery store. Just kidding, the stock market. And you want to make sure that when you do decide to sell them, you sell them for a higher price than what you bought them for. Now, diversification, remember, you don't want to just buy apples. You want to buy apples, bananas, milk, bread, because one year milk might not be doing so well, but bread and bananas might be up. So you want to make sure you have a diversified portfolio with different stocks or different assets so that it balances out should one of those things have a bad year. And that's it for this video. I'm going to talk more about compounding, interest rates, and more about the economy as well in later videos. So be sure to like, subscribe, and let me know what other things you hope I can talk about in later videos. But for now, I hope you enjoyed this video, and I'll see you at the next one.